Hi, everyone, and welcome back to the AI InterConnect podcast, where we spotlight the people driving change in real estate, AI, and automation. I'm Laurent, your host, and today's guest is Matt McDonnell, co-founder and managing partner of Stellifi VC. And Stellifi is one of the few venture firms deeply focused on PropTech and real estate infrastructure, backing early stage startup that are reshaping how the built world operates. Matt, great to have you here. Welcome to the show.
Yeah, thanks a ton for having me.
Wonderful. Okay, then it's a cool conversation. Let's start with you. Where did your journey into venture capital begin, and what drew you specifically to PropTech and the built environment?
Yeah, so it's a little bit of a long story. I realized I spent a lot of my is sailing, so doing character development and leadership training programs on traditionally rigged tall ships, and working for an organization that a lot of folks have probably heard of called Outward Bound, leading those programs. And one of the things that, towards the end of that part of my career that I realized, other than I wanted to have a family and a permanent place to, put my stuff, not sleep on a moldy pillow anymore, was that I sort of developed this skill set doing those programs that was very kind of early stage company oriented, which is doing hard things in dynamic environments with small groups of people where you don't really have an option not to deal with your problems, right? You can't just get mad at somebody and storm off when you're on a 30-foot boat. And so what I realized through kind of leading a lot of those groups was that that was a pretty applicable skill set as a leader in early stage venture. And so I realized, pretty early on, particularly towards the end of my time in business school, that I was really venture was really a good fit for me. I liked that, and particularly early stage, because I liked what the day-to-day looked like, but also was excited about the idea of building, right? That sort of 0 to 1 phase is sort of endlessly fascinating to me, and had both an intellectual interest and an interest in spending my time that way. But I didn't just jump into VC. I felt like first I had to get experience as an operator. And so I worked in an early stage startup. We raised some venture capital. It was a mobile content distribution platform for educational programming and content like apps and ebooks and things like that for children, which, played off of some of my early experiences in education. And after that company, I actually started a family office with one of those investors and got a lot of exposure allocating capital to early stage venture and to real estate projects. And so those two kind of fields were always very present for me. Along the way, I went to law school, and so I often think of real estate as translating legal documents into Excel files or Excel files into legal documents. And so kind of having those two skill sets, real estate was a natural fit. And I was also living in Austin in the 2010s, which, it didn't take a genius to figure out that property prices were undervalued. There was a huge growth opportunity. And so I took a little bit of a detour after that operating company into real estate development. I was sort of immediately blown away by how little technology there was. It was, this was is an industry still that, is 20, 30 years behind in terms of digital transformation that you've seen in a lot of other legacy businesses. And so I was really interested in sort of being a part of that. And then the other thing that I realized that brought me into the PropTech world was that real estate operators have a deep and abiding reverence for what works. And so what I noticed in that market is, as opposed to, say, a generalist VC thesis where you're hoping to get a large number of consumers as users, if you sort of get adoption correct in the real estate market, you have a real opportunity to own an enormous chunk of the market, right? You're not talking about single digit percentage penetration. You're talking about having all of the top 50 multifamily owners using your platform, because that's sort of how the industry works. Once you have demonstrated value, it sort of moves as a group, not very fast, and not, there's certainly exceptions to that rule, but like I said, if something's working, operators and owners will adopt it. And so those were kind of the little pieces that got me into it. And then Stellifi in particular, I had a friend, two friends who I'd known for a long time. We had been co-investing together, sort of nights and weekends in early stage angel deals, liked working together. And they ran and still run a value add multifamily real estate firm that's vertically integrated. So while I do development, they're very oriented towards the operation and buying of those assets. And so we had sort of complementary experiences in the real estate space. We had done a lot of deals together. And so Stellifi was really just an organic outgrowth of, some themes that we had been playing with for about 10 years before we actually started the firm.
I love this. Okay, that's a great introduction. And okay, then you did a lot of things. Did I understand you did a business school and a law school?
I did, yeah. I wouldn't recommend it, at least not the way I did it. I knew I wanted to go to law school. And so when I got off sailboats, I ended up continuing to work for an organization that operated a sailboat. And so spent a couple of years in an office at the end of that portion of my career. Knew I wanted to go to law school, but really felt a deficiency in terms of, I loved math as a kid, but I studied philosophy as an undergrad. And so, sort of got away from and wanted to sharpen my finance skills. So I decided that while I was taking a year to apply to law schools, I'd join an accelerated MBA program in Charleston, South Carolina, where I was living at the time. And so it was, I didn't think that was going to actually be my passion. I thought it was sort of rounding out skill sets. But what I sort of discovered there was I had a real passion for entrepreneurship and finance in particular. And then 4 days after graduating, moved across the country with my wife and dog and started law school. And that was a very shocking experience to go from kind of the amount of enthusiasm that I had to immediately realizing, oh my God, I don't know what I've gotten myself into here, but I certainly don't have the personality to be a lawyer. And so it was a great education, but it was ultimately sort of not the path that I chose to pursue.
Okay, wonderful. Thank you for the insights. Okay, then you told us a little bit about the story behind Stellifi. What gap did you see in the market that led you to launch it?
Yeah. So I think there are a couple of things. I think the most important thing is, when you think about early stage companies, there's kind of three pieces, right? You have the founding team, which, I think of as you want them to have both deep domain expertise and a lot of the intangibles that make folks really good founders. You have your product, and then you have your sales strategy or sales and marketing. And what I realized about the real estate market pretty early on is that a lot of the playbooks, say for selling SaaS or for distributing software in the B2C market, they didn't really apply to owners and operators. And there's a lot of reasons, but there's a lot of nuance when you're selling to, say, a property manager or, a large institutional owner of a portfolio that we felt like as a founding team, we could be really helpful with because we both had that perspective, but we also understood how our colleagues and peers that would finance our deals or that we would be co-GPs with also thought about their own businesses and then also optimizing performance on those properties. And so that was sort of the first inkling that maybe we could be helpful to companies in that way. And then on the product side, I felt like there was, I don't want to say a low bar, right? But there were so many opportunities to make improvements that it felt like, you weren't going to run out of opportunity. And then when you think about the founders, what you sort of had were a lot of people that had spent years in, say, a real estate private equity firm or doing development or being an asset manager, what have you, who really had deep expertise and were living and breathing these problems and banging their heads against the wall for a more efficient way to do things. And so, it sort of felt like when you think about those three core components for early stage investing, sort of, they all kind of lined up pretty well. And so I think that, at least in terms of developing the conviction to start those business or to start the business, those were really important. And then I think the other piece of the puzzle was that, I can't tell you how many times I've jumped on the phone with a founder to have an initial call. And within the first 5 minutes, they say something like, thank God you understand how this market works. I'm used to jumping on a call with a more generalist VC, right, who are very good at their jobs, but may not have the deep real estate expertise. And so I think that was maybe the fourth piece that I realized once we really got going was that, hey, there were very, very good generalist investors that were interested in this space and would be willing to bring us deals and collaborate with us because we had the industry expertise. And so I think that, ultimately those kind of couple of pieces were sort of the first hints, right, that this was a really compelling opportunity. And to say nothing of the fact that real estate is the world's largest asset class, right? It's multiples bigger than public equities. And so if you think about how much technology you see in the public equity world, and how deep that penetration is and how competitive it's gotten, well, here's a much larger pie, right, with much less developed technical infrastructure. And so I think that the other piece of it was that my view was that, we were sort of building the infrastructure for not a new way of doing real estate. A lot of the systems and processes are the same, but building the technological infrastructure for an industry that has been operating the same way for, a couple hundred or arguably 1,000 years. And so that just felt like there weren't that many opportunities that sort of had all of those things going for them. And that created a lot of excitement.
Yeah, no, makes sense. Um, how how has your investment thesis evolved since day one?
Constantly. It's been so our this first fund that we raised is a 2022 vintage, and so I think that time has been particularly interesting, right? So capital formation was tough, but also the real estate markets have had a very hard time in North America for a variety of reasons. Whether it's insurance costs are 60% higher than they used to be, materials costs have escalated, labor costs have escalated. And at the same time, you've seen rent rates come down. You've seen cap rates go up. So the value of assets is lower than it used to be. And so you kind of have this perfect storm of problems. And the owners of these assets and the property managers and the asset management firms were all and still continue to this day to look for any way that they can be more efficient. And they're also doing this with inherently smaller teams than they had, say, in the late 20 teens or very early teens. And so, part of the thesis was, look, if you can find a company that can get a toehold in the market by doing something in the existing value chain that is better, faster, and cheaper than the way that it's currently happening, you have a real opportunity to get deep market penetration and very fast adoption. And so I think that part of the thesis is still very, very present, but it's also evolved a little bit, obviously, with AI sort of coinciding with this first fund and becoming, basically a mandate for investors to invest in AI native companies. And so I think that we were fortunate in our timing, and that's always been a part of the thesis, but it's been sort of more top of mind for us over the last little bit. But in general, we're looking for seed stage. We like to lead seed stage rounds. So we'll do a little bit of pre-seed, but we generally want traction. And then we generally are looking for those three things that I mentioned earlier, which is, a great founding team, a great product, and then some level of understanding of that sales motion or go-to-market strategy that's very real estate specific. So I think those have been the persistent themes across the board. But we've definitely, sort of from a portfolio construction standpoint, early on, we did a lot of sort of big ideas. Then we did a lot of operational technology because that's what the market really needed and wanted at the time. And now we're, I think, a little bit focused as we round out this first fund on finding opportunities that are adjacent to fintech and insurtech for, sort of our last few investments.
Okay. Any and it's okay. Then you just said type of companies that are fit for Stellifi, but any fit for funders? Any kind of type of funders in particular?
Yeah. So, I mean, I think real estate experience, and it doesn't have to be, how should I say this? There's sort of a sweet spot, right? Where if somebody's been doing something in an industry for 25, 30 years, right, they might have developed some pretty deep habits that are helpful in that world, but maybe don't translate that well into startup land. And so I think that having deep domain expertise and then also having a lot of conviction about a problem. One of the companies that we've invested in is a company called Lenny, and one of the all the co-founders worked in institutional real estate to some extent as analysts. And so these were guys that were sitting in Goldman Sachs building Excel models for 16 hours a day early in their careers. And they have this passionate conviction that AI could do this job a whole lot better and a whole lot faster. And so I think that's one of those kind of hard intangibles about those founders is that any early stage startup is going to pivot. They're going to have, we sort of joke that they'll have an existential crisis every quarter in the early stage. And I think that that's pretty accurate. And so without that level of conviction about the problem, right, and that deep visceral feeling, it's sort of hard to not to persist, right? You don't generally see a lot of people that take that leap into founding a business that give up easily, but I think that it's that understanding of the problem that sort of keeps them motivated and also gives them the ability to talk to their customers, right? Because they understand, in that example, how much they're paying a whole team of analysts, right, to do work that their piece of software can do, at a fraction of the price, doesn't take breaks, doesn't need to go home to sleep, right? So you can sort of communicate those benefits pretty clearly with that, visceral problem understanding.
Yeah, I love it. Okay, then what major trends are you seeing right now across PropTech and housing infrastructure?
Yeah, I think there are a couple. So I think one is, I mentioned that at the end of this first fund, we want to get a little bit more exposure to fintech and insurtech. And I think that the one trend that we've sort of seen develop over the last few years is that those particular verticals are converging in interesting ways. So, particularly like just take the insurtech example. You're having more extreme weather events as an owner and operator. The kinds of coverage that you have to purchase when you own an asset has increased, right? After uh, 9/11, there was all of a sudden everybody had to have terrorist coverage. Now in Texas, where I live and develop, we all have to have windstorm coverage for our properties. That wasn't the case just a few years ago. And so I think you're seeing a very interesting convergence there. And then you're also seeing an interesting convergence with fintech, where one of the things that real estate developers and owners spend a lot of time doing is trying to predict the future, right? What's going to happen to rent rates? What's going to happen to our collections, right? How are concessions going to change? How's the value of this asset going to change? And all of that is financially oriented. And so you've sort of seen a lot of fintech offerings that have been successful in other industries not being copied, right? But sort of the same idea being adapted for a very different asset class and a very different workflow. So I think that convergence is really interesting. And then the other thing that we've seen is, I've really seen this more over the last year than any other time, is this adoption of what people talk about as universal data models, right? So if you think about the information infrastructure for real estate, it's incredibly fragmented. So, you have your MLSs, you have your CoStar for the commercial world or LoopNet, and those are just some of the data sources, but the other data sources are public. There's a lot of proprietary data, right? You have huge, well-resourced firms that have been investing in their own data infrastructure for decades. And so all of this data comes in a lot of different formats. And so what I'm seeing more and more of is a company that says something like, hey, we can unify all these disparate sources of data for whatever asset class they're targeting first, whether it's single family rental, multifamily, industrial, data centers, what have you. There's all sort of different applications. And then with that universal data model, putting an AI agent and AI app layer on top of it to solve whatever the particular problem is. And I would say that has become, over the last 12 months, I don't want to say the universal pitch, but there are lots of different flavors of that, which in general I think is sort of the right way to think about these problems. And that's what I mean by PropTech is exciting right now, because it's building the infrastructure for real estate to go forward. Those universal data models are one of the best examples of that I know of. That has to happen, right? And all that information has to get indexed and stored in a way that's usable, and that's really been ongoing. So I think those are probably the two or three biggest trends that I've been perceiving over the last little bit.
Yeah, I love it. Yeah, makes sense. It's okay. You have backed companies like Butter and River, which touch on automation and finance and home services. Where do you see AI playing a real role in real estate in the next 12 to 18 months?
Yeah. So we, just to be clear, so those are not two Stellifi portfolio companies, but I can give you, pretty good analogs. So I think, so one, that I mentioned already is Lenny, right? So where I think that data manipulation is currently a very labor intensive, and modeling, right, is very labor intensive, very hard to, you have to have a specialized skill set, and then you don't really have the benefit of integrating all those data sources. So I think that that's one place where AI is particularly useful. I think there's still some challenges, right? So it is not yet the case that all of those applications can just do all of the work that an analyst did. But what they can do is make one analyst as productive as, say a dozen used to be, right? So there's still some rework that I think is that technology to mature, and it's doing so rapidly. You're going to see a lot more of that analyst level function going away. I think the other one that's sort of related is decision enablement. So I think you're seeing a lot more. You've got this sea of information to swim through. How do you make those decisions, right? And how do you know what to focus on? And I think that AI is pretty good at synthesizing some of those issues. And then the other place is where there's a high volume so a really good example of that in our portfolio is a company called ResiDesk. And so ResiDesk is a tenant communication platform that will also allow you to automate leasing. It'll allow them to make maintenance requests, and then all of that data gets written back to your property management system, your PMS, whichever one you happen to use, while still keeping a human in the loop. And so I think that that's really, when you think about how that happens today, you've got a leasing agent in an office, a tenant has a complaint or a question or a problem. So they have to communicate with that leasing agent during business hours, right? Which, is already sort of clunky for the way people currently operate. And then they've got to go solve those problems. They have to scope the task for, say, a maintenance person or a third party vendor or what have you. And so you can take what, and this is I think a very good example of what I was saying earlier, is this is a value chain that already exists, everybody's doing. And if you can make it better, faster, and cheaper, then you have an opportunity to do a lot more things, right? You now have a data set which doesn't exist, right? Of all of the information about what this giant customer segment wants that didn't exist anymore, right? Which is the universe of renters. So I think then it opens up all sorts of doors to monetize that information. But you have to do something really useful and more efficient first. And I think that's what AI is particularly good at this point.
Yeah, I love your answer. Okay, then let's move on to let's talk about pain points. What are the biggest challenges you see PropTech funders are facing right now?
There's a bunch. So the market stinks. We have had a tough real estate environment, certainly in the US, for a while now. And part of that is, there's a lot of macro forces, right? I'm not a macro investor, so I'm not going to attempt to untangle all of that. But I think the results, right, are higher costs, lower values, lower rent rates, oftentimes driven by oversupply in a market, whether that's office that people don't want post pandemic, or it's not the right kind of office, or whether it's, I live in Austin, and we have been building as much multifamily as can be absorbed for several years. This is the first year where, we'll be able to absorb more units than are in the development pipeline in the last 4 years. And so I think in that environment, right, if you're selling technology, you're selling to customers that have existential problems, right? They're not just looking for marginal improvements in their operations. So you really need to, I think that's a challenge. And I think good products help increase revenue, right, which is what all of those operators want, or dramatically reduce costs, right? And those are the pinches that most of those owners and operators are feeling. So I think that's probably the biggest one, but there's some subtle variations on that, right? So if you're a software company that sells to developers, well, nobody's starting new projects. I mean, there's some public works projects, right? But the inverse of, hey, rent rates are now going to go up because there's not as much supply as there used to be. Well, the inverse of that is there's no supply because the capital markets have really been risk off in real estate because they've found better risk adjusted returns in other asset classes. And so if you're or 2023 and that project still hasn't been financed or started, right? And so you're also seeing a lot of these businesses having, very, very big pipelines that once the market opens up, they're going to have to deliver on. And if you're selling, say, hardware, right, well, now all of a sudden you've got to finance an enormous amount of inventory that, you wouldn't have if you had a more sort of measured pace of project starts over the last couple of years. So I think that the the real estate market itself is making it pretty challenging. And then, like I mentioned earlier, I think the last part is that it's a different kind of sale and it's a different decision making process within these firms. And I think that a lot of founders are still learning how to do that. But the real hard part is that they're learning how to do it maybe after those owners or operators tried out software that wasn't robust enough, right? And so you're sort of selling against decisions that you had nothing to do with that were made in the past, but they really color the buying decisions of your potential customers. And so I think those things are, they're challenging to overcome if somebody's had, say, a bad deployment, or the product didn't actually fulfill their expectations for one reason or another.
Yeah. And is I mean, you mentioned a little bit. Is fundraising the hardest part, or is it product market fit in such a fragmented industry?
Yeah, that's a good question. I think you'd probably want to ask a PropTech founder about how hard it is to raise money. I mean, I think there are investors out there. I know for
Yeah.
PropTech VCs, capital formation has gotten harder than it used to be, because in general, and this is also probably true for the founders, but in general, right, a lot of these more recent vintage funds haven't returned capital. And so the universe of, so there's no DPI, right? No distributions to paid in capital. And I think that those allocators that generally fund either early stage businesses as angels or direct co-investments, or their LPs and VC funds, they've sort of been on the sidelines for the last little bit, waiting for some of their earlier bets to sort of play out. So I can't imagine that it's not perceived as more difficult for those founders at this point. But I think that ultimately capital finds good deals. And so if, and you see this all the time. I was talking to a fellow that I know who works in venture capital and private equity secondaries. And I asked him, how are people kind of getting their heads around some of these valuations, say for some of these large AI platforms that aren't trading at a discount, right? Usually when you sell an LP interest in a software business, you have a 20, 30, 40% discount to whatever the last round was in order to get that liquidity. And with some of these AI businesses, AI native businesses, you're not seeing those discounts. And so I think that what that says to me is that there's still this idea or appetite that we're in a special kind of market and there are opportunities that shouldn't be missed because they will achieve such tremendous scale. And so it really is a fragmented funding market. And part of that is driven by that product market fit and adoption and usage. So I think while that's a challenge, if you can figure it out, it certainly makes the allocation side a whole lot easier. I think the counter argument to everything I just said is that generalists also like prop tech. And so I do think that the number of firms that are willing to take seriously a prop tech investment or opportunity has grown over the last few years. But I mean, in startups, right, it's all about your traction and adoption. It's hard to ever argue against product market fit being sort of the most important thing to figure out from an early stage perspective.
Yeah. And have any of your portfolio companies faced a pivot or unexpected obstacle that taught you something new about as an investor?
Yeah, man, lots of that's what I love about investing, right? Is that it's the learning curve is very steep always. I think that so I think it's mostly around at least a lot of the big lessons that I've learned. There's a lot of problems that are not at all unique, right? People problems, hiring the right CTO, right? All of those, building the right founding team. Those are hard problems that occur frequently and with a high degree of regularity. What I think is a little bit different right now is finding distribution models. So we have a company in our portfolio called Helix Intel. I think this is a good example where they provide what they call a predict and prevent engine for large building systems. So imagine a public school with a boiler, industrial grade HVAC, right? Those kinds of things. And what they originally were doing from a distribution perspective was going to the organizations and the entities that own these assets and saying, wouldn't it be nice to know more information about these facilities so that you can make better decisions about what preventative maintenance to perform, when to make capital investments in new equipment, in more efficient equipment, so on and so forth. And they had a lot of traction going that route. But what they realized in a lot of those conversations was that the reinsurers, the whole reinsurance market, is very worried because they're ultimately the backstop for the primary insurers who are insuring this equipment and have no visibility whatsoever into how these are doing, right? I mean, this industry is truly, with a few exceptions, still pencil and paper. And so what they realized was that sure, we can go and convince some number of users of the software, owners of these assets, to adopt the platform, but what's actually a whole lot more compelling is to go to the reinsurers and the primary insurers who can require the use of their platform so that they get the data they need and they get the information that they need to be more effective at pricing, at underwriting, at predicting losses. And so I think that that's, this is generally, and again, this is because this is the world's largest asset class. This is a lesson we've seen a couple times where it's less of a pivot about the problem you're solving, but more, we thought that the owner of the equipment had the real burning pain. Well, it turns out that the real customer has a bigger pain point, and you've sort of got to find that over time. And I think that that's, there's lots of examples of that, but I think that's sort of the most common kind of pivot that I've witnessed over the last little bit. It's really in the distribution model, and when you get it right, it really unlocks growth, right? And then all of a sudden, you're not selling it to a school at a time. You're selling to an insurance pool that has hundreds of schools, as an example.
Yeah, that's great. Makes sense. A lot of venture firms talk about being funders first. How does Stellifi actually support its funders in practice beyond just the check?
Yeah. This is something that maybe we do to a fault. We do operational meetings, right? So everybody has quarterly board meetings, right? And all of that. But we meet with every single portfolio company at least monthly and often more. And then usually, we'll set quarterly goals for ourselves inside Stellifi where we'll be focused on operational priorities for, say, a third of the portfolio at any given time. So we become, I want to say, executive team members, but we work very closely with either those founding teams or with, some subset of the executives on kind of very tactical problems at any given time, right? So one company right now, we helped them, we're very involved in rebuilding a technical team because the opportunity that they were going after required a very different skill set. And so, I was able to use my network, not just to source that person, right, but to do a lot of the product work that team was going to have to do, which unlocked a very big customer sale, which was a valuable proof point because there's a lot of other customers that look just like that customer and had that same sort of feature request. So, you can get pretty in the weeds. And then the other thing that we do a lot of is deploy the software in our portfolios. Collectively, there's several thousand units of multifamily and several development projects that are ongoing. So being able, instead of doing even all the way back in diligence, right? Instead of saying, oh, well, we want to do a customer interview with so and so, we'll just actually deploy the software on the portfolio. And so even if we don't move forward with the investment, which, at that point, right, we're pretty sure that we would be interested. But even if we don't move forward, we're providing real feedback as the owner and operator of assets that, can be taken pretty seriously. And then, you can continue to have those conversations and product refinements. And so we like to get in the weeds. We like, we're all serial founders, serial GPs specifically, and operators first. And so that's sort of the, wherever you go, there you'll be, right? So we can't just sort of leave that mindset behind and just say, okay, here's a check. And the other thing that's been really interesting is that a lot of these companies, all venture-backed companies right now, you're seeing smaller rounds, longer durations between the rounds, right? And that sort of creates a lot more opportunity for strategy, right? Like people are constantly talking about how, maybe these companies in the future don't need funding past an A round because then they achieve profitability, right? And so we feel like if that's an option or an opportunity that some of these businesses can pursue, then all of the effort that you put in up front from a operational, talent sourcing, strategic, customer introductions, right, what have you, those are things that you're going to get meaningful returns on later.
Yeah, I love it. Are there markets or customer segments you think more startups should be building for?
Oh, man, that is a great question. Definitely insurance. And I think real estate specific insurance. And then there's a lot of pedestrian problems that I think, a lot of founders maybe don't focus on, right? But this is back to that idea of if you have a toehold in the market, then you can open up a world of opportunities. And so, like, one problem that I know drives a lot of prop tech companies nuts and a lot of owners nuts is that, let's say you own 100 multifamily buildings across, a continent. If you own those assets, uh, you're going to get the way the entities and financial structures are set up. Each of those assets is its own business. And so let's say you sell a piece of software to that whole portfolio. Well, you get paid with 100 checks from 100 different property managers, still paper checks that show up at your office every single month. We have companies that get thousands of them. And so that's the way the business is done. And that's not the problem they're solving. But I would love to talk to anybody who is sort of thinking about what the next generation payment rails in multifamily real estate look like for exactly that sort of problem. And then you have AP and AR issues, you have collection problems. It's very hard and very manual to track. And so it's sort of maybe the thing I'm most excited about in this market, not just that specific problem, but as soon as you started solving the operational problem, you shone a light on a payment problem, right? That wasn't very obvious before until that software was adopted. And so I think that's those sort of second order problems are now really coming to light. And it's not just, hey, we're a better PMS or a better investor login platform or some of those kinds of examples. It's now, what are the second order problems that solving that first obvious one that was very valuable have now illuminated? And I think that's where you're going to see a lot of successful businesses over the next couple of years.
Yeah, thanks. That's great. What advice would you give to an ambitious founder trying to break into the space today?
I think there is, we think a lot about capital efficiency. So I think one metric that I usually will pay a lot of attention to when looking at a company is how much cash have they put into this business for every million of AR. And so I think a lot of founders, and this is a real problem in PropTech, right? This isn't a knock on people that adopt this strategy, because we have successful businesses in our portfolio that do both of these. Is, hey, look, the table stakes for a product to be adopted are actually pretty high, right? You're selling to an institutional private equity firm, right? You have to have 99.9% uptime. You've got to have a DevOps person on staff, right? The product has to work exactly the way they want it to work or be configurable. And so a lot of times I think, and I don't have data on this, but it's my experience that the cost to get what you would sort of think of as a minimum viable product is relatively high in the PropTech world. And so I think that's one approach, right? Is to spend, your first $2 to $3 million on getting a product right through it with your early customers. The other thing that I've seen a lot of, though, is people going out and maybe they got the product right, but they don't yet understand distribution. And so now all of a sudden they go and they raise their next round for sales and marketing, right? And a customer success team or what have you. And so now they have the same million or 2 million of ARR, but instead of having 3 million on the cap table, right, they have 15 or 17 or 20 or what have you. And that really changes your optionality if you have not been capital efficient in terms of your next several funding rounds. And as A rounds have gotten much more competitive and harder for founders to secure, I think that's caused them, that's been a real headwind and creates down rounds for those founders and those VCs. And so, there's a tightrope walk there between being penny wise and pound foolish, but also thinking very carefully about, every dollar that I'm investing, how does that really turn into the revenue and the traction and the growth rate that, a subsequent funder is going to want to see or demand to see.
Yeah, no, very important. Then one short question: something you believed 3 years ago that you have now changed your mind on.
Something I believed 3 years ago. I think one of the things that I've learned in the real estate world is, I guess to sort of answer it in that format, I used to think that, look, if you have a good asset in a good location and a good capital structure, right, that time is going to cure a lot of those problems, right? You'll have time for the markets to recover. Like we were talking about earlier, if you're selling to developers and construction companies, given a certain amount of time, right, they're going to get back to building. And I think that this recent financial doldrums that the real estate market has had really persisted a lot longer than I think a lot of us thought. Like there used to be a slogan every year, like survive till 25, exist in 26, right? Like it sort of, the finish line has kept moving. And I think that one of the lessons that I've learned from a PropTech perspective is that there's a real opportunity cost to waiting for the market to come back. And so I think that when you confront those sorts of situations, a faster pivot or rethinking your revenue model much faster, right, and not sort of sticking the course is a lot more important. And I think will continue to be important. I don't think we're going into like some magic period of 0% interest rates and low volatility again, right? I think that we're sort of living in somewhat of a new norm. And so I think that kind of faith in the markets rebounding and behaving very rationally quickly has been shaken for me over the last couple of years.
Yeah, definitely. That was great. Where can people find you, learn about you and your company?
Yeah, so stellifivc.com is our website. I have a podcast called Navigating Complexity where I talk to a lot of founders about some of the things that we've talked about today, but from a number of different industries. No conventionally successful person has followed a straight line. So that's something that I'm very interested in. So you can find that wherever you find podcasts. And then one of the other things that I've been spending time on, so mmmcdonnell.com is my personal website. And I've been working on a book that I'm going to publish here in the next couple of months to explain real estate finance and that sort of owner operator mindset to not only people that want to be real estate developers, but also to folks that interact with them and sell to them and maybe don't have that deep finance understanding of how that market works. It's sort of like a popular mechanics type approach to, it's somewhat technical, right? But written for a generalist reader so that people can gain a greater understanding of what the owners and operators, their sponsors are really thinking about.
Matt, that was great. My mistake. I forgot to introduce you as a podcaster, and there's many things you can teach me here. Matt, that was sharp and insightful. Thank you very much for being here and sharing your experience. I had a great conversation. Thanks again.
Yeah, thanks a ton for having me. I really enjoyed it.
Wonderful. And that's it for today's episode of AI InterConnect. If you enjoyed it, share it with someone who is building the future, or better yet, someone who should be. And until next time, stay curious, stay creative, and keep building. Thank you, Matt. See you soon.
Thank you.